Assalamualaikum warahmatullahi taala wabarakatuh. Wassalatu wassalamu ala sayyidina Muhammadin asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Allahumma rabbi zidni 'ilma warzuqni fahma. Right, so today we will continue on the next type of futures, which is hedging using stock index futures, FKLI. Right, so the concept of hedging using stock index futures or FKLI is quite similar with the hedging using futures crude palm oil FCPO. So we are still using the hedging techniques, which is the anticipatory hedging and hedging the current market positions. Okay, anticipatory hedging is applied when the portfolio manager wants to or expecting receipts, so FKLI. So this is when the portfolio manager or fund manager is expecting to receive some investment in the future, to be invested, to receive a fund for investment in the future. Okay. To be invested in the stock market, that to be invested in the stock market. So from now, the portfolio manager or the fund manager need to find a mitigation or risk management for this investment fund, so that when the time receive that investment fund, so the portfolio manager already makes some hedging for this investment. Yeah? So that we call it as the anticipatory hedging. All right. For the investment fund that in the hands of the portfolio or fund manager, so the portfolio or fund manager needs to do hedging the current market position. So this for the FKLI, so this refers to the investment in possession, investment. Okay, let me improve the handwriting. So this one is referred to the investment fund. Okay, investment fund that in the possession of the fund manager. Okay, the possession of the fund manager. So the first one is the investment fund that going to be received in the future, that to be invested in the stock market. So this one, hedging the current market position, is for the existing investment fund that already in the possessions of the fund manager. So the fund manager need to hedge this investment fund to avoid a further loss. So here, usually, for example, you can refer to the portfolio manager selling hedge 7.9 table page 2 to 5 in the textbook. So this usually relates to the fund manager with a portfolio. So with a portfolio of shares, that means that fund already in the possessions of the fund manager. And this fund manager need to hedge against a fall in the share price by selling or taking futures positions opposite to the current positions of the holding of a portfolio of shares. So if in the cash market, fund manager wants to sell, so that means in the futures market, the fund manager will take the opposite positions, which is buying the futures contract. Okay, so hedging strategy is similar. So you need to know what is the number of contracts, the contract months, and then what is the actions to protect the investment fund from hedging against the share price drop or hedging against the share price rise. And for the quantity or amount to be hedged, this is depends to the certain percentage that the fund manager wants to hedge. Sometimes it can be 100%, 100% level of hedging that the fund manager wants to hedge. So, for example, let's say the fund manager have 10 million in hands to be invested. So maybe the fund manager wants to hedge 100% or 80% only. So if 80% only, that means only for 8 million. So if it is 100%, that means it is hedged for 10 million. And another thing, so this is the percentage or the quantity or the amount to hedge. And the second thing is on the risk. The risk is you need to look at the beta. So the value of investment needs to multiply with the beta. Okay, so multiply with the beta to compensate or to include the risk. So that means the amount hedged should be higher when that investment has a beta, because the risk is higher. So the hedging should cover the risk. So if there's a beta for that investment, that means the fund manager need to hedge more than the value. So let's say the beta is 1.2. So that means the investment is riskier than the market portfolio. So this investment fund need to multiply by 1.2. That means the hedging must cover this beta, the riskiness. So the hedging should be more than investment fund, which is it should be 12 million. Okay, so we'll look at the example. Given the LCI is 150. All right, similarly, derivative market for the FKLI, we have the futures Kuala Lumpur index. Okay, so this is stand for futures Kuala Lumpur index. We are using the index because we are doing here hedging using stock index futures. And this one, the value is derived from the underlying asset, which is in the cash market. Okay, so derivative market is the futures market. Futures market. Okay, so the futures market is the futures Kuala Lumpur index or FKLI, and the cash market is the index market, which is the FBM KLCI. So this considered as the underlying assets in the cash market. Okay, based on this example, given the KLCI is 1050, so this is the index point, index point, and the value of a portfolio is 3 million. So this is investment fund. Okay, and if the portfolio manager wishes to hedge 80% only, that means it is 80 by 3 is only 80% out of RM 3 million is only RM 2.4 million. Okay, so that's the manager buy or sell. Okay, suppose in February, a palm oil producer anticipates that he will have 180 metric tons of crude palm oil. So this is for the FCPO. So FCPO we already discussed. So we just look at the KLCI. Okay, for the KLCI, we can refer to this example in the KLCI. You may refer to the this one. The key point all chapters. Okay, so the key point all chapters, which is okay, let me see. Okay, I think not in these slides. So it is so here, should the hedger cover only a portion, 80% or all, 100%? So that is depends on the price direction. Okay, the answer for the example is actually it is in the other slides. So 1050. Okay, let me open it, the slides for that. Okay. Okay, so this is the slides. Okay, all right, so we we continue to this example, slides 50. Here is slides, actually the slides 49, 49. Slide 49, so the answer is here. Given the KLCIs of 150 and the value of portfolio 3 million, if the portfolio manager wishes to hedge 80% against a price decrease. Price decrease means in the future price will decrease. So here, against the price decrease. So is it the manager will buy or sell? So here, So the manager anticipate a price decrease. So this is market bearish. Okay, so market bearish in the future, market bearish because of the price decrease. That means this fund manager need to sell first, sell high, sell first. Okay, buy later, buy low, buy low, buy later. When the price is already fall or when the price decrease. So how many contracts will the portfolio manager have to trade? Okay, so remember contract size now for the FKLI is 50. Contract size, so here contract size is RM 50, right? So okay, so contract size is 50. The trading strategy will be sell. Sell means short positions. Outline the strategy. So the strategy is the short positions to protect the portfolio value against the exposure, because the market wants to bearish, the market declining in the future, in the next maybe next 2 months, 3 months. So that means from now, so the fund manager needs to do short position, means sell, and later buy. Okay, so to protect the 3 million portfolio value against the market decline, the strategy is using hedging by selling or short KLCI futures now when the index is higher at 150. So determine the number of contracts that the portfolio manager will have to trade if he decided to hedge 80%. So the 3 million, 80% means 2.4 million. So then this one, how to get the number of contract is you need to divide the investment to hedge by the value of index and the contract size. 1050 multiplied by 50, so it's 50 to 500. Okay, so the 3 million or 2.4 million divided by 50 to 400, 500, sorry. So it is about 45.714. So if you round, okay, if you round, so it's a 46 contract. 46 contract. So that is for this one. Okay, next we look at the this one is a CPO. We already done in the class last time. Okay, wants to hedge using FKLI. So if you see that the way we hedge is similar like the FCPO, where we have the 4 quadrant of the 2 markets, cash market and futures market, then 4 quadrant of the opening and closing for cash market and futures, and the variation gain or loss column. Okay, this one is for the anticipatory hedging, which that the fund manager expect to receive fund in the future. For example, here expect to receive 10 million in September and will use the fund to buy the additional shares. Okay, and since now share market price drop and expected to increase in the future, means the market is bullish. Okay, so when the market is bullish in the future, so strategy is you need to long or buy now, long or buy now, and later short or sell the futures. So this is the futures contract. Okay, futures contract, futures contract. Okay, so this is in June. Okay, in the futures market on opening, you need to decide to long as a strategy, long futures contract. Okay, and then need to calculate the number of contract, which is the 10 million. So this consider as the 100% hedging, 100% hedging. So 10 million divided by the index point at that time is 1 index point now, 1250 multiplied by 50. So you got 160 contracts. So this is the solid number of contracts where there is no overhedge or under hedge. So 1250 multiplied by 50, so 62,500. So 10 million divided by 62,500, so it's about 160. Yeah. So by 160, add contract size 50. Okay, multiplied by index point 1250, so it's a 10 million. Okay, then on the closing positions or positions at maturity, which is on September. So I think the questions not here. So it's only example. The questions you need to refer to the page 214 in your text. Okay, on closing position September, where the anticipatory hedging for portfolio manager buying hedge is in the page 223. Yeah. So when closing positions at maturity, where the fund manager is actually received the 10 million, then in the cash market, the share market is actually rise 5.6%, making the investment in equity market more expensive because the price rise. Okay, so here the price rise. Then in the futures market, since it is the earlier one in the opening, we are doing long, so now we need to do short. Okay, so the points index, since the price rise by 5.6%, the index also rise from 250 to 1.56, 5.6%. 1250 multiplied by 1.56%, so it is 100. Okay, so 5.6 divided by 100 plus 1.056. 1.056 multiplied by 1250, so it is 132 points. Okay, index is named as a points. Okay, points, index points. So 1320. So here you can see that sell high, buy low, sell at 132 points and buy at 1250 points. So you have again here by the difference is 560,000. So you need to multiply the contract and the contract size, number of contract size, and the index point, and the differences between the opening and closing. So this one you offset. Okay, so you get a gain of 560,000, and this gain, okay, you add with the value, then you get the 10,560,000. So this 10,560,000 is your total portfolio investment value or total portfolio value. Okay, so the increase in investment cost 10 million is offset by the gain in the futures market 560,000. So this one, the gain is used to offset the higher cost of shares. Okay, so this one, if portfolio manager hedging using FKLI, when a portfolio manager selling hedge or hedging the current market position. The previous one is anticipatory hedge, where the portfolio manager expecting to receive fund in the future. And now is the hedging current market positions, where the investment fund already in the hands of the fund manager, already in possessions of the fund manager. And to avoid from the investment value drop when the market is bearish. So when the market is bearish, that will make the investment value drop. Okay, the investment value drop. So the hedging strategy is the portfolio manager need to sell now, sell or short now in opening, and buy later. Okay, buy or long in the closing. So this one, so buy or long in the closing, short or sell now when it is opening. Okay, for example here, KLCI index 1350, portfolio manager has 10 million in the hands and expected that market is bearish, where the price drop. So what happened? Opening, this portfolio manager need to hedge this investment fund in the futures market, buy, short, or sell the futures contract. So you need to calculate the number of contracts, which is the 10 million. So this is considered as 100% hedge. Okay, 100% hedge. 10 million divided by the index points that we log is 1388, multiplied by the contract size RM50, so 144.09. So here there is a decimal. That means possibility of the unhedged. Yeah, jadi fund manager decided to round down, so from 144.09 to 144, so that is unhedged. So 9,993,600. So this is the value of investment at the opening, after multiplying the number of contracts and the contract size and the index point at the opening. Okay, then on the closing and the forecasting of the share or index is really happened when the index point dropped from 1350 to 1280. So now the investment value of that portfolio reduced by 518.52. So this is how to calculate the reduction, which is the existing index point minus the closing index point minus the opening index point divided by the opening index point multiplied by the amount to hedge, 10 million. So 515, 5.8, 5.8. Okay, and what happened in the futures market? So we need to close the futures contract. Earlier we are doing short futures contract. Next we need to close it by doing long futures contract. Long futures contract. So with the similar contract number 144 and the contract size 50 multiplied by the current index. So the current index dropped to 1280. So you got 9,216,000. So you sell a short high index and you long lower index. So that give a gain. So this is a gain. So again in the futures contract. Okay, gain in the futures contract. So the differences between the short futures contract 993,600, okay, minus with a 9,216,000, so that is 777,600. So this is a gain in the futures contract. So this gain in the futures contract offset here, offset. Okay, so here also you offset. So you got a gain, so offset against the 518.52, then you get a net worth which is 259,081.48, and plus with the investment value 10 million. So now the total investment value is 10,259,081.48. Okay, all right, so now we want to do the this one is for the currency futures. Next one to do example in the questions. Okay, so I hope that you have this question July 2022. So last time we already we did 4 questions February, February 2022. So we already did for question 3, part A, MCO, simplistic berhad. We did these questions last week. All right, so we'll continue in part B, June 2021, for Mr. Park. So this is the questions February 2022. Okay, we do it this question first. Okay, in June, Mr. Park, a portfolio manager. Okay, a portfolio manager manage a 15 million portfolio fund that closely track the movement of the FBMK-LCI. Okay, remember FBMK-LCI becomes the underlying asset in the cash market. He is extremely bearish. This is a market trend. Drop on the stock market in the coming months. Mr. Park would likely to completely reduce his exposure. So usually this one, the fund is already, so this is investment fund. So the investment fund is already in the hands of the portfolio manager. So need to hedge against, okay, price or share price or index drop. Index hedge again, index drop. So if Mr. Park want to hedge against index drop, that means dia kena buat long positions. That is the strategy in futures market. Okay, in futures market. So dia kena long positions in the futures market. Okay, sorry. So not long position, but short position against price drop. That is similar to seller. Okay, short positions. But nanti dia akan buy later when the price is actually drop. So it's a short or sell positions in the futures market now. So this is for the opening. So opening. And later closing when the share price or the index is actually dropped, then this portfolio manager needs to do long positions. Okay, so current FBMK LCI is 1,600 points. 1,600 points. Okay, so this one is the cash market punya, because it is FBMK LCI. So FBMK LCI is the underlying asset in the cash market. FKLI for August 2021. So this is the futures. This is belong to the futures market. Okay, futures market trading at 1610. Advice on the appropriate action that Mr. Park should take. Show him the outcome of the strategy if after 1 month. That is the closing. Okay, stock market falls. Okay, because forecast bearish market. Bearish market. And the FBN LCR stands at 1480. So this is what happened in the cash market later. Okay, and August FKLI. So this is what happened. The points drop in the futures market. Futures market. 1483. Yeah, so 1483. Okay, so now we want to do okay, as usual, you just do the quadrant too. Okay. So the types of market, so we have here opening, so this is the market. So we have the opening, we have the closing, okay, then we have the gain or loss, gain or loss. Okay, so here is the cash market. So cash market opening, this is in June. 1 month later, it is 1 month later is July. Okay, so in June, so the FBMK LCI is 1,600 points. 1,600 points. So you just record it. Okay, then in the futures market, first thing first, you need to calculate what is the number of contract. Okay, so the number of contract here now is the number of contract is the investment fund to hedge, which is the RM 15 million. Okay, RM 15 million divided by index point. Okay, index point futures. So you need to calculate index point futures. So FKLI for August 2021. Okay, this is June, August. So closing dia dekat August ni. Sekejap. Closing dia dekat. So dia beli kontrakmen dia pada closing dia Julai, yes, sebab dia nak 1 month after, tapi dia beli contract FKLI for August. Sebab memang sometimes you can close earlier, no problem. Okay, so here the strategy, since Mr. Park ni already have that 15, dia tak nak harga jatuh, so dia kena sell now when the price is higher. So short sell lah kat sini. So short sell futures contract. Okay, what is the number of contract? The 15 million. Okay, strategy short sell opening. So the number of contract is based on the futures point. Futures FKLI August point 1610 at the opening. Sebab kalau at the closing August is 148. 1 month later 1483. So here kita kena ambil to calculate number of contract, calculation based on the futures index point at the opening. So 1610 multiplied by 50 contract size. So that give you contract size is about 186.34. So 186.34, so it's a decimal. So we decide to round down. So it is under hedge, So round down 186. Okay, ni current means opening lah, 1006 for the cash, and trading at 1610. This is opening for futures. Jadi the opening index point for futures we use to calculate the number of contract. Okay, so now we can calculate what is the value of future contract at the opening. So we take back the index point that we lock FKLI August. We lock the index point at the opening, which is in June. 1610 multiplied by the contract size 50 multiplied by the, so kita akan dapat 52, sorry, not 52. So 1610 multiplied by 50, so it gives you 8500, and multiply by the index, multiplied by the contract number. Okay, so saya start dengan contract dulu lah. Contract, contract is 186, contract, number of contract multiplied by contract size multiplied by the index point, multiplied by 186. Okay, so you got 14973. So here is RM 14973,000. Okay, next you need to, okay, on closing, they close in July. Window buying in August, you can close it earlier, no problem. Okay, in actual cash market, the FBMKLCI now is actually dropped to 1480. So we need to calculate what is the reduction in the value of our investment. So index point in July 1480 minus index point in opening 1006 divide by index point opening 1006. Okay, then you multiply by the investment value 15 million. Okay, 15 million. So you got here 1.1. So this is a reduction in investment value. Okay, reduction in investment value, which is 1. You put in bracket 1125,000. Okay, 1125,000. 1480 minus 1006 divided by 1006. Okay, multiplied by 15 million. Okay, that is 1125,000. So this is a loss to the Mr. Park because reduction in the investment value 1,125,000. And this reduction in value should be offsetted against a gain. So whether we get a gain or not, so we'll see. So closing, take opposite direction, which is if earlier opening is a short sell, so now it's a long buy. Long buy, futures contract. So 186 contract multiplied by the contract size 50. So now the index point is 1480. That is for the 1480. Okay, that is for the this one FBMKLCI. So August futures market, August FKLI is 1483. So multiplied by 1483. Yeah, so 1483. So you got here RM 13 791 900. 791 okay, 791 900. So the difference, so you buy low, you sell high, you sell high, you buy low, so that give you a difference of gain. Okay, 1,181,100, and this you offset Okay, so that gives you the net effect. So this is the net effects, right? So net effect between this reduction in the value 1181. So that is 56,100. So 181 minus 1,125,000, 56,000. Okay, plus with the portfolio value 15 million. Okay, so the total portfolio investment is 15,056,100. So this is the total investment value. Okay, let me bring. So this is the total investment value. So you see that if there is no hedging, okay, if there is no hedging, if there's no hedging, the value of investment is 15 million minus the reduction in the investment 1,125,000. Okay, which is how much is it? 15 million minus 1,125,000. So it's 13,875,000. Okay, with hedging, the total value of investment is 15,056,100. So hedging is benefit. Hedging is benefit because it increase the value, increase the total value of investment. Okay, so back to the questions here. The questions advice on appropriation that Mr. Park should take. Show the outcome. So this is the outcome after 1 month. So on the advice is take the current. Okay, let me show you the solutions for February 2022. So this is the advice given to Mr. Park, which is okay. Take current, the hedging strategy is the current market positions, and should take the opposite positions in the futures market. Sell 186 contract of August FKLI at 1610. So now the investment is increasing from 15 million to 56,100 with the hedging. Okay, so that is one of the example past semester questions, February 2022. Questions, Mr. Park. All right, so we'll do another questions for this FKLI, which is I plan to do questions last time, which is we start with July, I think, with July 2021. Wazi, okay, Wazi. All right, so Wazi is an investor that owns share portfolio value at 3 million with an estimated beta. So now there is a beta here. Okay, 1.2. After consultation with the trading analyst, she decided to hedge her portfolio against any unforeseen downturn in the equity market. During the consultation, analysts suggest that there is a strong indicator that market is highly volatile. Negative market sentiments lead to unfavorable. So this is a hint that market is bearish. So when market is bearish, so what we are going to do now or opening, is we need to sell short position, take short positions. Short positions. Currently, the FBM KLCI currently means this is opening for cash market and opening cash market, okay. cash market, and the opening for futures 1775, which is May FKLI, but trading or locked in now. Now it is not given here. Now is when, because we are given only May, but when is now, we are not being told. Is it now is the January, February, March, April? Okay, May, suppose in May market falls by 130 points. So this is what happening on closing. Okay, on closing, and May FKLI closes at 1560. Calculate the impact whether you want to see the reduction in the value. If she hedged 80% using futures contract, using futures contract. Alright, so as usual, kita buatlah macam tadi, which is so we have a market here. We have the cash market, okay, cash market, and we also have the futures market. Okay, then we have the opening. Okay, opening. So here we just put what is our FBMK LCI, which is 1760 points. Okay, 1760 points in the cash market opening. Okay, 1760 points. And what happened in the closing? Okay, closing later. So opening for futures market. Okay, futures markets, our strategy will be sell short or short sell. Short or sell position. Futures contract, all right? Futures contract. So that means we need to calculate what is the number of contract. So the number of contract is the amount hedged. Okay, I'm calculating here. Okay, the number of contract is the amount hedge. Amount hedge is 80%. Amount hedge is only 80% from the 3 million. So RM 3 million multiplied by 80% multiplied by the beta. So this investment maybe is a riskier investment. So we need to cover all the risks. So we have to hedge above the 3 million. Which is 3 multiplied by 1.2 means 3.6. Multiplied by 80% means 2.88. Okay, so 2.88 million. This one, 2.88 million. 88 million. Okay. 2.88 million. And divide by, okay, index point current 176, futures punya index point current futures 1775, index point current futures multiplied by the contract size 50. So 1775 multiplied by 50, 88750. 88750. So this one 2.88 million RM. 88750. So that means the value here, number of contract is 2880, meaning 2.88 million divided by 88750. So it's about 32.45 contract. So we round down. Okay, it's under hedge 32 contracts. Okay, 32 contract. Then we put it in the here. So 32 contract. So 32 multiplied by contract size 50 multiplied by the index point 1775. 1775. 1775. So index at opening. So here is index at closing. Futures. Okay, futures. May FKLI, May Futures Kuala Lumpur Index close 1560. So here kali dengan 1560. So strategy is the long, close it long by FC contract 32 multiplied by RM50. Okay, so and market falls by 130 points from 170. So here on closing, here closing in May. Okay, market fall. So 1760 less 130. Okay, less 130. So that is 1630. 1630. So this 1630. Okay, so we minus 1630. Okay, so 3 million. So 1630. So this is amount that so you can take the difference 1763 tolak dengan 1630 boleh juga. So since here kita selalunya if you are looking at this example above, so we take the difference here, isn't it? So this one kan, tadi, sorry, example before, okay, we are get the difference of the points, the differences in points. But here 1480 less 1006. But here the points, no need to take the difference in points because the difference is already given as 130. So we just take the difference 130. Okay, divide by 176. Kali dengan alternative, you boleh juga nak kira macam tadi. So no problem. No problem. You can calculate. Okay, you can calculate by the difference, tak ada masalah. So 130 divided by 1760 multiply by RM, investment value 3 million, and don't forget beta dia 1.2. Beta 1.2. Okay, 3.6. Is it 3.6 kan? 3.6 kali 3. Sorry, 3.3 kali 1.2 is 3.6. Okay, so 130 divided by 176 kali dengan 3.6. So it is 265. So this one is the gain or loss. So here is reduction because from 1760 to 163. So reduction in investment value. Reduction in investment value. Okay, reduction in investment value. 265 909. So 908 or 909. 265,909. Okay, so so yang saya kata tu the difference, so you boleh buat macam ni juga, 170, 60, 1630. 1630 less 1760 divided by 1760 multiplied by 3 million kali 1.2. So boleh juga you nak buat macam tu. So you got the differences of negative 130 because reduction divided by 1760. Okay, then multiply by 3, multiply by 1.2, so you got 265,909. Okay, so this one I just take the difference terus because it's given in the question as 130 points kat situ as the differences of the market drop in points. Okay, this one for the futures market, so it is RM 1775, so 2.84 million. So here is RM 2.496 million. So the differences, so here is gain because you sell high, you buy low. So it's a gain in the futures contract by 344,000. 344,000. So you offset here and here, you offset. So you get a net gain. or net effect, net gain, 344,000 minus 265,909. So 78,091. So dia selalu suka menambah dekat sini, 8 tu jadi 81 pula So 78,091 and plus with the investment portfolio value, okay, portfolio value, which is 3 million tadi, 3 million. So the total investment value is 3,078,091. So this is the total investment value. Okay, 3,078,092. So this is for the investment value for the fund managed by Wazi, ataupun fund owns by Wazi in its share portfolio, 3,078,091. So this is an example of the futures where the investors or the portfolio fund manager doing hedging using futures Kuala Lumpur index. Okay, so I think enough for today as the example of FKLI. So we'll continue another example in the next video. Till then, thank you very much. Assalamualaikum.